Welcome traders to today's presentation on how you can earn between 2 and 4% or more average daily return on your investment, and you'll never risk more than $100 per contract traded. I would like to thank you for taking time out to join us today. My name's Michael Guess. I'm the president and CEO of TradeSafe, and I'd like to share with you how a rules-based, Boolean logic, objective, mechanical trading system, and professional coaching will finally bring you that elusive holy grail of trading itself, consistency. I do want you to know, though, that this is being recorded, and of course, Murphy's Law notwithstanding, it should be processed and uploaded into our archives before this evening, and then that way it will be distributed to you later. If you're watching this recording already, well, then great. We've already achieved it. So, for those who are attending right now, a link to this recording will be included in the first of a series of follow-up emails, so do keep an eye out for them. Now, as I said, I'm Michael Guest. That's me. I've been a professional trader actually for about 25 years, and I founded TradeSafe nearly 20 years ago. I've graduated over 3,000 students. I've created a multitude of indicators and trading systems, and I have a background in psychology. I was originally trained as a psychotherapist, and I apply that to help you and my students with that all-important issue of trading discipline. Now, in case you want to ask me some questions and you're not able to because maybe you're watching a recording, I want you to know that you can reach me. As a follow-up, you will receive an email, as I said before, with a link to a limited number of consultations that are available. We only have just so much room. These aren't going to be a sales call. You're going to get to talk not to a salesperson, but directly to me, Michael Guest, the actual developer. I will set aside a full hour of my time just for you so that you can get your questions answered and we can have a dialogue about whether this is really a good fit for you or not. A lot of people say, well, why do you want to have people talk to you? Because typically most people are beat over the head to buy, buy, buy. I don't do that. I want you to have a no pressure consultation so that you can come away feeling that your time was well spent. And that way you can decide for yourself if TradeSafe is really right for you. So keep an eye out for that special email. It'll have two links, one for another replay if you want, and of course the all-important link for scheduling time with me. It'll show you my calendar, dates and times that are available. Don't hesitate because they do fill up fast. Now, before I go further, I'm not going to read all of this boilerplate, but I do want you to know that you shouldn't be trading with money that you can't afford to lose. That's pretty obvious. I'm sure you've heard that before. Only trade with discretionary income. But there's something else that I'd like you to know. A lot of people in the finance industry, they tend to make all kinds of promises and guarantees. Actually, they're in violation of the FTC. The FTC, which regulates the internet, and that's what you're on if you're watching this right now, the FTC says nobody, and it's not about traders, it's about anybody, they're not allowed to make a financial promise or guarantee. So what I do in order to stay within the boundaries of the law is I will share with you what I think is a reasonable expectation based on our history. And of course, I'm certainly willing to discuss with you offline if you schedule with me how our system has performed in specific conditions. All right, with all that being said, let's go ahead and jump right in. What do you think some of the biggest problems are today when traders first get started, particularly with day trading? And that's right, this system, The trade safe mechanical system, I want to make that clear from the outset, is for day trading. Now, please don't switch this off and say, oh, I can't day trade, I don't have time, or I'm not interested, or I've tried it, it's not for me. Give me a chance to at least explain how this can work for you, even if you do have other employment or other commitments. So, before we get started on any of that, let's at least address one of the biggest problems that a lot of traders, particularly beginners, have. Take a look at that screenshot over on the right of your screen, and you'll notice that it's pretty busy. This is actually from one of my charts from a couple of decades or more ago, and it's loaded with indicators. It's way too busy and cluttered. And that is a problem because way too many people starting out, they think more is better, or they'll be seduced by the flavor of the month or even the flavor of the moment. Well, I was one of those myself. I bought everything under the sun until I finally realized indicators by themselves aren't sufficient for what you really want. Sure, we want to make money, but you want to make it consistently. You don't want to have those wild equity swings, make a bunch in 3 or 4 days and give it all back on the last day of the week. We've all been there, done that. What you need, though, to achieve real consistency, like the professionals do, is a true mechanical system. This is something that is rules-based, and it's proven and back tested. Ours is back tested over more than 20,000 trades over the last 19 or 20 years. And we know that this does work. Even through the big recession in '08 through 10, it was still cranking out the profits. So you want a system, something that is no shade of gray, it's cut and dried, black or white. There is no confusion about when to get in. It's extremely specific, and it will even manage your trade and exit your trade for you once you're in it. It is a true mechanical system. So that's what we have here today. However, some people say, yeah, well, I did some day trading last year in 2018. Unfortunately, though, the volatility levels were so high, I couldn't find any trades that, had reasonable risk levels. Well, I want you to know that even with high volatility, our system has worked because we don't put all our eggs in one basket of a particular chart or type of chart. We actually have an adaptability factor that lets us cope with increasing volatility. Fortunately, I'm speaking right now in 2019, the volatility levels have gone back down to normal, so that's not an issue. But if they come back, I don't want you to worry. Another big problem. See that micrometer over there? What do you think that stands for? Tolerances, precision. You need real precision in everything that's involved in your trading. You need to know absolutely to the tick and to the second whether to get in or get out, because close enough, it is absolutely not good enough. So you need to know before you pull the trigger on a trade what that risk is going to be and exactly where you're going to get in and what the probabilities are for you to be able to have a winner versus a loser and about how much you're going to make. So all of these things, you want those in your favor because let's face it, if you really want to achieve the holy grail of trading itself, consistency, you want it from front to back, from entry to exit. And speaking of exits, let's look at this little screenshot of an actual trade. You can see the big red arrow pointing to our what is called a setup bar right here. In trend following trading, and that's right, this system is a trend following system. That's been around forever. It's as old as dirt, well proven, universally acclaimed as being the safest and the most profitable way to consistently make money. So in trend following, there are only very few ways to actually enter and exit. Entries typically in trend following are done on a pullback. So if you're in an uptrend like you might see here, you have a retracement or a pullback briefly away from the trend that started further back here. And like a stretched rubber band, it's wanting to snap back and continue that trend like you see there. Well, with our system, we don't chase the market. We don't use market orders. We use a stop limit order. We park an order one tick above what is called the setup bar. And I'll give you all the details and show you with actual charts a little bit later. But you'd park that order just one tick above the high of the last bar in the pullback and let the market put you in the trade. Once you've hit, if you're using a scaling out exit strategy, let's say you took some profit right around here and that paid for the trade, then what do you want to do? You want to be able to relax and let the system take you out of the trade. That's why we have an automated trailing stop indicator. And as you can see, it adjusts itself based on several factors, which I'll explain a little bit later with real trade that I'll show you. But it adjusts itself. It gives breathing room when the market is really on a tear, and if the market is starting to peter out, the trade or the trend rather is starting to fade or maybe even go into congestion, then guess what? This indicator will rush up and lock in the profits. And as you can see with the big red second arrow, price itself will take you out of the trade by making contact with that trailing profit stop. It's not a protective stop. It's now a profit stop. So that in a nutshell is a visual of what you can expect so that you don't have to guess where to get out. All of our exit strategies are predefined. That's right. We have more than one way to get out of your trades. Instead of a one size fits all in, all out, and trying to guess where to get out. Oh, do I get out at a fib level, a support or resistance level, or something else? We actually have a predefined way of determining how strong is the trend. And I'll go into that also a little bit more a little bit later. Once you know what the strength of the trend is, you will pre-select one of three exit strategies. You're basically going to either do one of two things. You're going to scalp or you're going to scale out. To use a baseball metaphor, if you don't have the wind at your back and maybe you've got, some difficult conditions, then you just want to bunt and get on base. That's scalping. All in, all out at a quick and easy to reach target that you know has high expectancy, high probability of being a winner. On the other hand, if you got a lot of wind at your back, you'd want to swing for the fences. You'd want to load the boat and you'd want to be able to at least hit an easy to reach target and pay for the trade, but you want to stay in that trade as long as that trend is viable. And that's what the trailing stop indicator does for scaling out. So I'll explain a little bit later how you know when to scalp and when to scale out. And this alone, a lot of people tell me, is one of the biggest reasons why they love the trade safe system. It's not a one size fits all. And because it adapts, it gives you the highest probability of having consistent winners. And that's what you want. You really want consistency. How do we do it? Through something called cycles. And a lot of you who may have thought earlier, oh, he's talking about day trading. I've tried it. I don't want to do it and sit there all day long and get eye strain and hemorrhoids. You don't have to. Not with this system anyway. Part-time trading is actually possible. How do we do it? Because instead of using a single chart to gauge whether you want to get into or out of a trade and evaluate what the conditions are for Whether that trade, if you do take it, is going to go very far. Instead of one chart, why not use the metaphor of that camcorder? It has a lens that allows you to zoom out, zoom in, go from wide angle all the way in to close up. How do you do it with charts? Different chart settings. So if you're intraday trading and you have the largest setting for intraday, it's obviously less than a day, but a lot of people think, oh, yeah, I'll just make sure I'm following the trend of the daily or the weekly or even the hourly. You know what? Those are all too big a setting because if you're entering on a really small setting chart to keep your risk low, there is no correlation at all above a certain level that I'll share with you a little bit later. I'm going to give you the actual settings that we use in our classwork for my students. Okay, so bear with me on that. But the point I want to make here is you start with a larger setting, you zoom in, and you get what I call the dominant cycle. That's probably good for an hour or two, whereas the wide angle bigger setting is probably giving you an idea of what the trend or lack of it is going to be for the whole intraday period. But if you zoom all the way into close up, you want that low risk surgical entry. That's what enables you to keep your risk under control. So you basically want to take advantage of zooming out and zooming in by utilizing not just the drop down menu settings that are in your day trading platform. Typical amateur platforms only have fixed settings in those menus like hourly, 30-minute, 15-minute, maybe 10-minute, 5-minute, 3 and 1. Those are generic. You don't want generic. You want to be able to have each chart set up just for the market that you're trading. And I'm going to show you exactly how to do that. I'm going to give away that information to you so that you'll be able to try it on your own. And then you too can zoom out and zoom in and properly evaluate the conditions of the market and be able to adapt. So coming back to cycles, no, it's not Fibonacci. I know there's a nautilus shell there. I put it there just as a reminder. Fibonacci really doesn't work well anymore. It hasn't for nearly 20 years. As more and more computers get involved and the human factor gets less and less, then Fibonacci, which is based on actual living relationships, real live creatures like humans, it has less impact on the market. So moving away from that, what are we going to look at in terms of cycles? What's left? Well, let's try something real simple. I don't care whether you are looking at a daily chart or a 1-minute chart or anything in between. A chart's a chart. They all have similar patterns that repeat over and over again. And what we do is exploit that pattern recognition so that this system will work on all trending markets. First of all, I want to reassure you, in case you got the mistaken idea early on, that this is for futures and commodities, for example. It is not. It was designed for all trending markets. Now, I have been day trading stocks since the early 90s, but I have stopped doing that. And if you want to know why, please do schedule a call with me. I don't have time to go into that right now, but there are a host of reasons why the stock market is not a level playing field for the little guy. So if you want to know more about it, please do schedule time with me, and I will share with you what I think the best quality markets are for the small retail trader. With that being said, let's look at ratios. This is a pretty important concept. As I say, we don't use a single chart, a no one size fits all. In order to get that custom tailored approach to determine trend strength, you need to use multiple charts or time frames as they are sometimes called. That first chart on the left, if you follow my cursor, it had been in an uptrend, and I'll explain what that means later, but right here, it started to go officially into a downtrend. Well, that's the big picture, the wide angle for that part of the day. But if you were to zoom in on that segment of the day 300%, that would give you the middle setting chart for the dominant cycle, which is good for maybe an hour or two. And if you kept right on going another 300%, 3-to-1 ratio, that's the low risk surgical entry. See how granular it is compared to that one and this one compared to the other one? That's what we're looking for, because once you have these three charts, you can see what the market is capable of giving you. How do we do it? Well, now I'm going to give it away to you. These examples that I'm going to give you are for what are called the minis. In other words, we've all heard of the S&P, the Dow, the NASDAQ, and the Russell, the big four indexes or indices in the United States markets. So, as I say, I'm going to focus on those right now instead of the stock market because they have inherently good trending qualities. You don't have to search through 12,000 stocks to find out which ones do trend. We also know that currencies trend, so you could look at something like the euro, the 6E in the futures market. Some of you might want to also consider things like the energy complex. Well, the common one that almost everybody looks at there is crude oil, but guess what? Crude oil doesn't trend really well. It tends to congest, and then if you get a breakout, it doesn't always follow through. It sometimes comes back right into congestion. That's called a breakout fake out. I would recommend instead of crude oil, because it is a highly volatile market, natural gas. It does trend smoothly. So I'm getting a little bit off topic. I wanted you to know that you do have many, many choices. And even if you limited yourself to the minis, that's going to be more than enough markets to give you more than enough opportunities each and every day for trading. Okay, so the minis. How do we figure out what settings to use for our charts? Well, it goes like this. The minis, just like the pit traded bigger brother version of them, is traded in Chicago, here in the United States. That's the central time zone. And it opens at 8:30 in the morning central time zone. And even though it trades around the clock 24 hours a day, each one of them has a brief break so they can kind of reset things and then start up again. But effectively speaking, they're around the clock. But the volume isn't consistent around the clock. You want the period of the day where there is the most volume, where you have most of the traders committed to taking trades, and that's going to be during what is called the daytime trading session. So that's from that 8:30 open in the morning until about 3:15. So what you need to do is subtract the number of minutes from the open until the close. Now, typically I ask people for feedback and say, get out your calculators, or if you're really good at math, it's only second grade math, do it in your head. But I'm going to go ahead and save you time, and I'm going to give you the master number that you start with for the minis. It's 405 minutes. That's how many minutes there are in a daytime trading session from 8:30 in the morning till 3:15 in the afternoon. That is the equivalent of a daily chart, not the drop-down menu choice that says daily. It won't be quite as accurate. This is dialed in precisely. So if you're using some amateur platform that doesn't allow you to set specific settings and it only forces you to use whatever's in the drop-down menu, well, I'm going to share a saying that we have here in Texas. I live in Austin, Texas. And the saying goes like this: don't take a knife into a gunfight. You want to be able to use a professional grade tool for your day trading. Otherwise, the pros are going to clobber you. So we'll get to what platform I do recommend a little bit later, but assuming that you have a platform that lets you dial in whatever you want for a setting, we'll start with 405. And then from there, we go for the next smaller number that divides into 405 without a remainder. That's 135, still way too big for a 135-minute bar chart for day trading. And then you keep on going down, down, down until you run out of numbers. Well, what's the next biggest number after 135 that divides into 405? 81. Again, these aren't numbers that you hear tossed around a lot. That's because this is a much more precision-oriented way of getting the settings for your tools so that they work the way you want them to. Now, remember, I talked to you earlier about that 3-to-1 ratio where you zoom in 300%, you go from wide angle to the dominant to the close-up. Well, if you take that 3-to-1 ratio, everything you end up with still divides into 405. So what's 1/3 of 81? 27. Well, a 27-minute chart, that's pretty close to a 30-minute chart in those drop-down generic menus. But you know what? It's more accurate than a generic 30-minute chart, at least for the minis. So if we keep that 3-to-1 ratio going, what are you going to end up with? 1/3 of 27 is 9, 1/3 of that is 3, and finally you get the 1-minute chart for entering your trades. So these are the settings that we use in this system that I'm giving away to you. A wide angle view, a 9-minute. You may say, that's just not big enough. Trust me, anything above a 9-minute chart you should use for swing trading. And a 3-minute chart is the dominant trend, and the smallest risk level is a 1-minute. Now, yes, you could take trades on 3-minute charts, but if you want more opportunities and less risk, you would want to use the 1-minute chart. So the 3-to-1 ratio is important. But I mentioned a little bit earlier about how the volatility was really rough last year, and that several people were complaining, you know, even on the 1-minute time frame, I would see risk levels that are just way too big. I can't find hardly any trades at all on a 1-minute chart. Well, to give you the maximum number of opportunities, whether there's volatility going on or not, we utilize tick-based charts. So besides the 1-minute chart for entry, we have 2 additional charts that are tick charts. So that's a total of 5 charts. 2 of them, the 9 and 3, are used for evaluating the trend with the 1-minute typically. But when you have what is called trend agreement, and I'll get to that concept a little bit later, then you can choose from either the 1-minute chart or from one of the other tick charts. Now that I've shown you how to do this, you can do the same thing for other types of markets. With that being said, let's go ahead and look at a symbolic uptrend on the 9-minute, and on the 3-minute, it's meandering slowly downward. And if you look at a 1-minute, maybe it just began a really hard, strong rally. If you consider each one as adjacent to each other, no 2 chart settings that are adjacent to each other are trending in the same direction. It's kind of a mix mash. What you really want is this. Are you going to get that every day? All day long, or at least hopefully much of the day? No. Let's be real. The market tends to congest a lot of the time, so that when you do get a trend on whatever chart you have, then you want to know, well, do I have trend agreement with the other charts? Remember, you want to have the wind at your back so you can swing for the fences. Well, how much is enough? Well, now I'm going to give you another freebie giveaway. This is how my trade safe students assess a potential trade safe setup. In order to help them remember it, I teach them a rhyme. It's a mnemonic. And it goes like this. The minimum is the 1 and the 3 need to agree. Best is if all 3 agree. That means the 9, the 3, and the 1, and that includes the tick charts, are trending up or down together. This gives you the potential for a really strong move with a lot of follow through. So why would you throw away a perfectly good follow through with a lot of money you could make on a scalp where you get in and get out real quick? You don't want that. You want an exit strategy that keeps you in the trade as long as possible. You want to scale out. And I'll demo that with the charts themselves in a little while. Well, as I said, getting all 3, the 9, 3, and 1 to agree, it doesn't occur that frequently during the day. But what you will see more frequently when you have it is the least amount of trend agreement. That will be your entry time frame and the next higher time frame, which would be your 1 minute and or tick and the 3 minutes. So if at least the 1 and the 3 agree, you have the possibility of a somewhat weak and brief price move with not a whole lot of follow through, but it is something that you can exploit. So if you throttle back on your exit strategy and don't have a high expectation of follow through, you want to get in and get out with the same full position, and you want to hit a quick and easy to reach target. That's a scalp. Our typical scalps last anywhere from a few moments to a couple of minutes. And if you're trading really small size for the minis, for example, maybe 2 or 4 contracts, that's a real quick pop of about $100. So, you can knock out a few $100 worth of those, even if you don't get a lot of trend agreement. But people also ask me and say, yeah, well, that's all real good, but I want to make sure that I'm really entering when there is a good trend. Markets tend to chop and get congested. How do I know when I'm in chop or congestion? Well, when I take you to the actual charts, you'll see it. But if you look at this screenshot, I want you to examine 2 areas. First, down below, these bands of color. Right there and right there. You can ignore the red line. We'll get to what that is later. It has nothing to do with trend. When you have a period of green, you're in an uptrend. When there is no color, it's blank. Therefore, you're in congestion, right? And then when you're in a downtrend, it's this kind of pinkish color, and then there's congestion again, and there is an uptrend. But to give you additional reinforcement so that you can see it as it's occurring, we have this rectangle that is plotted. Once a certain number of bars are in a tight sideways pattern, and I'm not going to give you the rules because that is part of the system, but it has very specific requirements and tolerances. So the box doesn't appear right away. It won't appear until after a certain conditions have been met. And that's why you can see right here, the color green stayed green, even though the box reaches all the way back to here. And then we officially had congestion right here. Now, notice price was moving out of the box, out of the congestion pattern. A lot of people think, oh, it's getting out of the congestion pattern. Let's quickly jump in. That's called breakout trading. And the problem with breakout trading is breakout fakeouts. Quite often, it'll go right back into congestion. Now, in this case, it did keep going and get out of congestion and start a brand new trend, which no, we don't use that for entering our trades. Remember, this is a pullback or retracement oriented system. But I want you to know that when you get a breakout, it is a 2-step process with very specific metrics, very specific conditions that have to be met. And You will get audible alerts. Your computer will talk to you in plain English. It'll tell you the market if you happen to have more than one market open at a time. It'll tell you which chart, and it will tell you what's going on, whether you're now in congestion, starting a breakout, or have a confirmed breakout, or if it was a breakout fake out. All of those things, your computer will talk to you and let you know that, to let you know that you're in congestion. And of course, visually, I already showed you what to look for here as well as here. So we were briefly in a downtrend there, then we went back into congestion here. Now you may say, why doesn't the box just not show for periods of time? It's because it's going all the way back to its originating point, and as long as congestion is back in play, then it will keep extending itself until there is no more congestion. All right? So I want you to know you don't have to figure out anything. You don't have to draw anything or count any bars or do that. It's fully automated, and it'll display on each and every chart for each and every market that you are following. And it'll do it in real time to let you know tick by tick, moment by moment, if you're really in congestion or not. And of course, that goes for changes of trend also, not just congestion. If you are in a downtrend and the market went into an uptrend using our trend indicator, then you will hear alert where it'll tell you again which market, which chart, and that it is a change of trend. This will enable you, if you don't have that trend congestion, to take a break, maybe go in the kitchen, fix a sandwich. And if you hear an alert, you can come back and pay attention and focus and be ready well before a trade sets up. That way you don't miss the trade. Okay? Much easier that way. So you'll be told and you'll be shown whether you have a breakout, a fake out, and whether you have a trend, whether it's up, whether it's down, etc. Now, I mentioned earlier in a previous screenshot, and this is very, very similar, that if you had a trend and a pullback, and this would be our setup bar, and you would enter above that bar on this one right here when it broke through the resting order, if you were to scale out, say somewhere around here or so, you would have a paid for trade and you can relax. And then the automation takes over and will trail the stop all the way up until it detects that price is going to touch it. And when price touches it, by that time, notice how close it's getting to price. It's locking in profit, getting the meat off the bone, as I say. And that's good because look, it started to go into congestion here. So this system is sensitive to things both when you're in a trade and when you're not in a trade and you're evaluating, well, what are we going to be getting? What do we need for a trade? So you don't have to guess where to get out. You'll have that automation. It'll trail the stop for you in real time. It'll adjust itself, give more breathing room, get closer when it needs to, and it works on any chart, whether it's the time-based charts, the 1-minute chart, or those tick charts. It's included and it does it for all of them, and it kicks in once you've scaled out. Then you have a paid for trade, and then you have that trailing stop automation. Now all this adds up to a roadmap that you can use for winning. It gives you a clear signal, a series of steps to get into the trade, and I'll show you what they are in a little bit. And it will automate the rest of the trade and take you out under the optimum conditions. So if you use this system, what can you reasonably expect? Now, I told you at the beginning, the FTC says that I'm not allowed to make any promises, so I won't break the law, but I will tell you how you can use this system to reasonably expect things. So I also mentioned a little bit earlier that I don't prefer the stock market. I'm not saying that you can't use this system on it or even Forex, for example, which is really the Wild West and is barely regulated. And you have a huge pip spread and a bunch of other things that, in my opinion, disqualify it for day trading purposes. But if you were to stick to the minis, just as an example, and you trade anywhere from 2 to say 4 contracts, that's still a very, very small number, then you would want to make sure that you're properly capitalized. You know, if you wanted to day trade the stock market, the SEC requires that you have at least a $25,000 account. Well, that's a barrier for a lot of us, right? What if I told you that the margin requirement for a single contract for the minis, whether it's the S&P, Dow, NASDAQ, or Russell, typically it will be about a $500 maintenance margin. So if you were trading 4 contracts, then you'd want at least a $2,000 account. That's a lot less than $25,000. But guess what? If you went below $2,000, you couldn't trade 4 contracts anymore. You could only trade 3. So in order to prevent stress, I recommend being fully capitalized and having way more than you need. I do recommend about a $5,000 account size as a minimum if you're going to day trade the minis. More would be better. All right. So now that we know where all this is coming from, your return on your investment is what? Your investment is that $5,000 account. So how do we get the 2 to 4% daily ROI, which works out to $100 to $200? Well, it's real simple. If the system generates signals and you took a trade every time there was a signal, no matter which chart it appeared on, or, well, let's just restrict it to one market. We're not going to cheat and say you could pad it by trying to trade a lot of markets. Let's just say if you traded one market and took all the signals all day long, each and every day, Monday through Friday, for a full month. That's 20 to 22 trading days in a month, right? You added up all your profit. You had winners, you had losers, but you took your net profit and you divided it by the number of days that you traded, say 20 or so. That's going to give you the average daily return on your investment. It works out to about $100 or $200, and if you divide that into $5,000, that's your 2 to 4%. Now, I'm being candid here. 2 to 4%, if you did that all day long, every day, day in and day out, all month long, very few traders really do that, let's admit it. You might say, oh, well, if I trade part-time, I'm not going to get those kind of returns. That's actually more of a minimum rather than a maximum. Typically, you will do quite a bit better than that. So I want you to be reassured that even if you are a part-time trader, you can make plenty of money. Now, some of you might say, well, 100 or 200 a day, that's lunch money. I need to make a lot more than that each day. Well, I understand. Then obviously if you have a much bigger account than 5,000, you would certainly trade more than 4 contracts. You trade more. Therefore, you make more than $100 or $200 a day, okay? And for the rest of you who say, well, I would like to be a bigger trader and make that kind of money, how do I do that? Well, I'm going to give you another freebie. This is a safe way to increase your account size before you start taking any money out to live on or spend on other stuff. Build your account to a level where it is really giving you what you want and need. How do you do it? Really simple again. If you started, say, with 4 contracts and you had a $5,000 account and you took all of your trades and you had winners and you had losers, however long it took you, maybe a few days, maybe a week, maybe more. Just depends on, how little you trade or how much you trade. But when you finally build your account up by $2,500, that means it's now a $7,500 account. You're going to add a pair of contracts. You're not doubling, just slowly adding a pair. That way you don't get psychic indigestion, right? Now, if you hold everything constant, then it takes a little bit less time to reach that next threshold of another 2,500 to get from 7,500 up to 10,000. And when you get there, you're not trading 4 contracts like you did when you started and 6 contracts when you're at 7,500. You're now trading 8 contracts. Very simple, very slow, very conservative. You don't want to strip your gears and jump ahead too fast. That's what gets traders in trouble. Now, there is going to be a limitation because some of you may have thought, oh my God, if I keep doing that, ultimately I'm going to be the master of the universe like Gordon Gekko. No, there's a couple of reasons why you won't hit that theoretical 4,800% return annually. It's really simple again. First of all, no market has infinite depth of liquidity. So there's a limit to the amount of contracts that you could enter a trade with without getting a split fill, or trying to get out of a trade without getting a split fill. So some markets have a lot more depth, others don't have so much. For example, the S&P Mini is called the ES. Yeah, you could trade literally thousands of contracts. However, that's too much of a good thing. When I started trading the ES in 1997, it was wonderful. It trended beautifully. It was a level playing field. It was first in, first out electronic trading. Nobody could jump ahead of me in line. I loved it. It was a lot better than trying to go to the pit, which is what I'd been doing before. But eventually the institutions caught on. They said, wow, look at all that liquidity. You know, these hedge funds, these mutual funds and others, they said, let's throw off some of our risk. Let's hedge and go over there and do the opposite of whatever's happening today in our fund and offset it by taking trades in the opposite direction on the ES. Pretty soon I started noticing that the ES was not as trendy as it used to be. I'd see spoofing, I'd see algorithmic trading and program trading. I'd see 10,000 contracts in thousandths of a second and then they reverse. Well, I gave up on the ES back in 2001, but I did keep trading the other 3 minis, the Russell, the NASDAQ, and the Dow. So coming back to this hyperinflated return on your investment, what's more realistic? We know that's not real, just like that unicorn. First of all, let's examine something else, not just the depth of the market, but the realistic truth is you're not going to trade all day, every day. Very, very few people do that. So let's cut back on that. Let's say you traded 15 days out of the month, okay? And you were a part-time trader each of those days. Maybe you only traded in the morning. Okay, 2.5, 3 hours, whatever. And winners and losers out of those 15 days, maybe instead of $200 a day, you were on the lower end of the average, maybe only $100 a day. Well, that's still a $1,500 profit on a $5,000 account by the end of the month. And you know what? That's over 30% return on your investment by the end of the month. There are hedge fund managers who would kill to make that in a year, let alone in a month. Our system has actually generated that much and more in a week, and even in a single day. So it is entirely possible. It all depends on whether you're sitting there at the time those trades were coming in. If you're out on the golf course or doing something else, well, you missed the opportunity. So people, pay attention to the fact that your return is not going to be an equity curve that's a ruler straight line. A lot of people assume that's what they want. And then the real world gets them and they go, oh my gosh, it's up, it's real down, it's back up, it's back down again. They want something that's smoother, more consistent, because that's what we're after, right? Well, you have to factor in the final variable, humans. We are not all robots or clones. Your results are going to vary at first until you get calibrated and benchmarked to this system. This system is not something where you push a button like an ATM machine and it spits out money and it does everything for you. No, you're involved. You're the human. You get taught this system. You need to know the rules. It's very simple. I've taught an 8-year-old child. And when you do know the rules, if you follow the rules, then you are among those elites who actually get to enjoy consistency and really great returns. But what if you don't follow the rules? What if you're an impulsive trader, an overtrader? Or what if you just can't pull the trigger? You have analysis paralysis. Either of those extremes or anything in between isn't following the rules. So what we do is help you by benchmarking you. Now, I'll discuss benchmarking later. What I would like to do now that I've laid the groundwork is to take you to the charts themselves. I'm going to pause right now. And now I'm going to resume. I've switched screens. And what you're looking at now is an actual live shot of my charts for the TradeSafe system. Now, sure, I do have more than one monitor. Please don't run out and buy 4, 5, or 6 monitors. It is absolutely not necessary. And in my background in neurophysiology as a therapist, I learned that the brain just can't process that much info reliably. You've heard the old saying, multitasking doesn't work. Well, it's been thoroughly disproven. You need to focus on just a few things. So, to prove my point, I've assembled all the charts inside my main monitor so you can see all of this. Yeah, that means, yep, you can actually use a laptop if you want to use my system. Though I don't recommend that if you're at home, you rely on that little bitty laptop screen, right? Not a good idea. I'd at least invest a couple of $100 or so in an external monitor of a decent size. That way, you'll be able to have more reliable trading and you won't make mistakes. Same thing goes for the touchpad on your laptop. It's very easy to make a mistake and fumble finger into a trade that you didn't mean to. Just get a cheap mouse and plug it in. All right, back on topic. What are we looking at? We are looking at my screen. If you divide it in thirds, the middle third right here is the 1-minute chart. That's what it says. And you may say, oh, well, what is this program? Because you told us before, don't use amateur software. What is this so-called professional software? It's NinjaTrader. Now, I've used more than 24 different platforms over the last 20 years or so, or nearly 25 years, God, of day trading. And I even was a beta tester for System Writer, which later became TradeStation, but unfortunately TradeStation didn't keep up. So really, in my opinion, the one and only platform that I recommend for this system, you can use other platforms, but you'd have to sacrifice some of the features because you'd have to try to recreate them within those other platforms. I wrote this system so that you can have these charts ready to go in 5 minutes. it plugs right into NinjaTrader. That's the name of the software. So please trust me when I say NinjaTrader has plenty of horsepower under the hood to get things done and be automated and do things other platforms cannot do, but it's also super easy to use. It's a very friendly application. Takes very little time to get up to speed. With that being said, I was pointing here to the 1 minute chart. That's dead center. That's what we use to enter a lot of our trades on. Over in the right-hand third are the 2 tick-based charts right here. We're not actually going to use those today because I have a limited amount of time. We're going to take a trade using just the 1 minute chart. But before you can even take a trade, you got to have that trend agreement. Remember the rhyme, the 1 and the 3 need to agree. Best is if all 3 agree. Well, over in the left-hand third are the 3-minute chart and the 9-minute chart. And I'm going to first maximize the 9-minute and show you what its current condition is so you can see it better. I'll slide it over. Looking at the trend indicator down below, it seems to think that it's in an uptrend, but look, it cuts off right here. You go up above and you can see that, oh yeah, there is a box and the current bar is inside that box. So this is not an uptrend. This is congestion. So, remember I said you don't often get all 3 in agreement? Well, let's wait a little bit longer and see if we can get out of this congestion and into an uptrend. Meanwhile, let's go look at the 3-minute chart, this one. This is a 300% magnification of what you're seeing right here. That's this right there. So let's zoom in on this window, bring it over, and you can see that it had been in a pretty long-term uptrend until about 1042, and then it went into a downtrend. That's what that color symbolizes. And then boom, right here for about 1 bar's worth of time, it became officially congestion. And of course, the box reaches back further than when it started, being recognizable congestion. That's right there. But guess what? It did manage to break out. You can see that right here and go into an uptrend. So it was green down below for a few bars, but uh-oh, breakout, fake out. It went back inside the box, the blank area. Thank goodness, though, it did finally break out a second time, and currently, as of this last bar, we're in an uptrend. Real simple, real direct. It's green, it's an uptrend. You can see it's not in the box. So, gosh, if the 3 is in an uptrend, I hope the 1 minute is. Let's go see. Let's zoom in on the 1 minute. Unfortunately, it's in congestion, as you can see right here, and it's blank down below. It had periods of downtrending and uptrending and congestion between those periods, but right now it's in an uptrend. So what I'm going to do is park this, go back into what I call the dashboard mode, where you see each of the charts sort of like gauges on a dashboard. And I'm going to turn on the replay of this market. And this is the Dow, the YM, and we're going to watch it for a little bit here, and I will speed it up. The nice thing about NinjaTrader is you can fast forward and go through the dead stuff. So I'm going to speed it up a little bit until we hear an alert. Well, not yet. Let's speed it up some more.
EM, 1 minute, break EM, 1 minute, breakout confirmed.
All right, I'm going to pause. You heard through my speakers and hopefully through my headset's microphone that the 1 minute had a confirmed breakout. And you can see we're out of the box here and it's a green color. So do the 1 and the 3 agree? The 3 is still in an uptrend. Oh, great. Why don't we do this? Let's let it keep going a little bit longer and see if the 9-minute gets out of its congestion, and then we'll be able to choose from among the 3 exit strategies the one that lets us try to stay in a trade the very longest. We'll scale out and we will then trail a profit stop. So I'm going to turn it back on until we hear an alert. A little bit longer. And
EAM, 9-minute, breakout. EAM, 1 minute, congestion cancelled.
okay, so the 9-minute did finally confirm its breakout. I'll maximize it for a moment. You can see the green down here. It's well outside the box. So guess what? All 3 agree. It's green, it's green, it's green. You have trend agreement across the board. That means we'd want to pre-select an exit strategy that maximizes the follow through. So you don't need to look at these anymore once you have trend agreement. You can just focus on the chart you want to take the trade on. So I'm going to zoom in on just this 1-minute chart and I'm going to move it to the middle. Before I do anything, I want you to know that instead of using something called the DOM, D-O-M, that stands for depth of market, that's nothing more than a window that floats above your chart, and it has an ascending and descending column of numbers. It's the bid and the ask, called a price ladder. Not real intuitive. You have to take your eye off the ball just to go click on one of those moving numbers. It's really hard to do. That's so 20th century. If you want 21st century technology, then you want to be able to click directly on the chart itself to place your order, as I'll show you in a little bit. Well, that feature in NinjaTrader is called Chart Trader. So I'm going to open up over here a hidden panel that shows the settings for our exit strategies. There you go. All I'm going to do is have you focus on, even though I've got a lot of different exit strategies besides the ones that you would use, because I'm in continuous research and I have different ones for different markets. But right here, notice the one that's highlighted. I'm going to scale out with 4 contracts at $100 of profit. That's basically what that exit strategy is calling for. But it has a lot of automation built into it. Rather than show you the settings, I'm going to let you watch it in real time. So going back up here, we'll hide that panel. And I want to reiterate what we've done so far. We found trend agreement. At least the 1 and the 3 agree. Best as if all 3 agree. So we have all 3 agree. We've already pre-selected. We didn't wait to get into the trade. By then it's too late. We've pre-selected the appropriate exit strategy that will give us the best results for this condition of lots of trend agreement. Now, what are the other steps to getting into a trade safe trade? The second step is a pullback or retracement. I talked about that earlier. So I'm going to do a little bit of illustration here. This is not an art program, let's face it. It's a trading program, so don't expect really good art from me. But this line right here represents the path followed by this trend of bars. And this line here is going to be what you'll see later when we do get a pullback. And you want the last bar in the pullback, the deepest bar in the pullback, to either touch this moving average right here, right there, or come within a certain distance of touching it. In other words, it may not quite reach it, or it may overshoot it, and the top of the bar will be below that moving average. But as long as, whether it's above or below the moving average, it's within a specific number of ticks distance. Now you may say, how am I going to know that? I can't measure it. Guess what? The system's automation does it for you. When the time comes, I will show it to you when we turn things back on. But I want you to know in theory that what you're going to be looking for is step 2, a specific minimum number of bars in a retracement. You want it to be at a direct angle, preferably between 45 and 90 degrees. You don't want it to just meander along, barely moving downward. You want it to either touch or come within X number of ticks of the moving average. That's the second step. The third step, which we'll get to when I do turn on the replay, has to do with that red line that we showed you earlier. It's sharing some space with the trend indicator. This red line is an oscillator. I'm not going to tell you which one of the many oscillators. We have the RSI, CCI, stochastic, and others. But this one has been completely repurposed. It is not off the shelf. It is very resilient and responsive. All we want is for it to get, in this case, when price comes down to the moving average, you want this oscillator to get below the setting for oversold. Now, a lot of you that have used oscillators have been taught, maybe it was right for what you were taught then, that you get into the trade when the oscillator turns out of overbought or oversold. We don't do that because indicators lag. All we care about is, did it get into overbought or oversold? Was the condition satisfied? So don't worry if it gets in there and then backs out, because a lot of people, they see in whatever they were taught, oh, it went into oversold, now it's out. Oh, shoot, is this really going to work? Don't worry about it. In this system, that's nothing you need to be concerned about. And then the final fourth step is going to be risk assessment. I'll show it to you when we actually have the live replay here. That'll be the last thing we do. So let's pretend we had a certain minimum number of bars, and the last bar is right here. I'm going to draw a little line here to represent that last bar. Where would you put your order? One tick above its high. Right there. So I'll put a horizontal line to represent a resting stop loss order. Well, this retracement is like a stretched rubber band. It wants to snap back in the direction of the trend. And that's why we let price action itself put us into the trade. No lagging indicators. Use price action, because that way you're already generating some momentum in the direction of the trend. Makes sense, I hope. Now, one more thing before we go to the actual replay of the live trade. Stops. A lot of people, probably 95% of all traders, use what is called a fixed dollar stop. In other words, they risk the same amount in every trade, whether it's $100, $200, or whatever amount. Well, the thing with that is sometimes you are risking maybe more than you need to. I've had people say, your stops are very small, that's too tight, but they don't know from where they speak. In other words, let me explain why. If you were to enter a trade where this horizontal line resting order would be, and let's say that your target is somewhere up here, and we'll put another horizontal line up there. What if price goes, and then it starts to peter out somewhere around here and then heads back down and it never reaches the target? You had a potential loser turning into a potential winner turning into a loser. Because if your stop was down here, then yeah, that really doesn't feel good, and it makes it hard to take the next trade, especially if you had maybe two losers or hopefully not more in a row. Well, we don't use fixed dollar stops because of a concept called logical stops. Works like this. If you were in an uptrend in this case, and you entered the trade and price moved, what's left behind down here? You see this familiar V-shaped bottom? That's really support right there. And if price just goes part of the way to the target and turns around and goes down below that support level, that's technical analysis 101 that would tell you you're not in an uptrend anymore. You're in a downtrend if you go below that support level. So why would you want to stay in a long trade if the trend is down? That's why the logical place for a stop is not at that low, because it does get retested, but one tick under it. And that, of course, has to be after you're in the trade. So that's the concept of a logical stop. And by extension, if the range of your setup bar, meaning from high to low, is small, then the distance from where you'd enter, one tick above the bar, to where you could be stopped out, one tick below it after you're in the trade, well, that's pretty close together, so you'd have a smaller stop. If the bar is bigger, well, then these would be moving further apart up to what? The maximum. The maximum is in the trade safe system. If you're trading the minis, for example, $100 per contract traded. And as I said, it could be less. If the bar size is smaller, then you're going to have less than $100 risk. That's pretty nifty, huh? And if you're scalping, well, we lower the bar even more. $70 maximum risk. And it could be less also. So I hope that makes sense to you. I'm going to go ahead and erase this right here. And then we'll go ahead and get into the trade. All right. So now what we're going to do, I last had the market moving at 20 times the normal speed of the market. So when you see things happening really fast, that's not how fast, let's get rid of this other line. That's not how fast the market really moves. In fact, we'll slow it down when we get very close to the full pullback. I'll slow it down to normal speed. So it's coming down lower.
3-minute, congestion cancelled.
We got an alert already. And let's pause. The other alert was just letting you know that congestion on the 3-minute chart was canceled. You may not have noticed this, but you remember the box that used to be here when we were in congestion and then we broke out and went into a trend? Well, that congestion isn't going to stay effective indefinitely. If price has satisfied very specific conditions, then we don't need to worry about a breakout fake out. Well, it did satisfy those conditions. Again, that's part of the system, so I can't tell you all those little secretive details till you start using it. But this box disappeared, and left in its place is a phantom outline of the congestion box. So that other alert that you heard was from the other chart that's off screen, the 3-minute. Its box also disappeared. All right, so what have we got here? Step 1, trend agreement. Step 2, here's our pullback. This is not the best quality pullback. It sort of started down, went a little bit up, but it did finally come down. And look, the last or deepest bar so far in the pullback is this one. It's actually making contact with the moving average. But what if it hadn't quite reached it, like this bar here, or even that one, which is closer than that one? How would I know how close I'm getting? to satisfy the second step. Look in my data box. This is a readout here of all my indicators. Oh yeah, it's got the open, high, low, close, but it also has other things. Right now, if I put my cursor lined up with this bar, it says that the part of the bar, the bottom of the low of the bar, that's closest to that moving average, it is 9 ticks away. Well, again, I'm not going to tell you how the minimum distance, what that number is, but I can assure you that with this bar, notice it says 0 down there, where it says Rule 21 right there. It says 0. So we've satisfied the second condition. Both steps 1 and 2, they're satisfied. Now, once you've satisfied the first step, you don't need to go look at those other charts. I've told you that twice, but I want you to be reassured you don't need to leave this chart. Okay? Now, the third step is independent confirmation using an uncorrelated indicator. That's a fancy way of saying we're not going to just give you more of the same thing like another pullback to a moving average. It's got to be completely unrelated in the way it is gauging the full pullback, that it's reached its maximum point of excursion. And that's where this oscillator comes in. All it needs to do is get into oversold. Now, right now, it's just nicking it. So what I'm going to do is turn it on for a few moments and then pause. And when I pause it, I want you to notice, okay, right here is a timer that lets you know when the bar is about to finish. If you wait for the bar to finish, even if all the conditions were met, you don't want to jump the gun if all the conditions are met, because maybe if you put an order in, all 4 steps were finished, maybe the bar grew bigger after you put your order in, and it would put you in a trade, and maybe the risk would have been more than it should have been. So if you wait till after the bar is finished, you might miss the next bar that could have put you in the trade. So a good way to compromise would be the last few seconds. So what I do is I keep my cursor where I want to park my order. Right now it's lined up with the high of that bar. If you look at the hairline over on the right, it says 23,371. If I move it up 1 tick, it's now at 23,372. Now I'm going to give you a pretend order right now. I right click and a menu pops up with a lot of stuff. Yeah, I know. But we're going to ignore all of it except for this section here. That's where the orders are. And we're going to even ignore all of these orders except for the last one, because that's the one we want. It'll always be the last one. So you don't have to worry about which one to choose. And this order is going to be, because we're in an uptrend, we're going to buy. It's on a stop limit. We said that earlier. We already know we want it to be 4 contracts and at that price. So listen as I click and then watch as you see the line appear where the order will be. Listen for the speakers.
Order pending.
Order pending. My computer talks to me. So this is where we are. 1 tick above the high of that bar. Now, you might have said, but it never did get oversold, Michael. That's right. It didn't. So if you jump the gun and put an order in when you shouldn't have, you click here.
Order canceled.
Order cancel. All right. So what I'm going to do is I'm going to leave this on normal speed. And then I want you to notice as the next bar starts that the oscillator goes into oversold. So let's put it at, and there it is. So
Order pending.
see it's oversold right there. And is the risk still what? Oh, well, let's check that. The risk, if you look in that same data box in the lower left corner of my screen, right here, it's risk. It's going to gauge the risk moment by moment, tick by tick. letting you know what the risk is per contract. You don't have to gauge it or guess it and calculate anything. It's $95. Is that within the maximum of $100 if we're scaling out? It is. So we have a valid order right here to buy 4 contracts on an SLM, a stop limit order. Okay? Real simple. And we just, like a stretched rubber band, let the market put us into the trade. So let's turn this back on.
Order filled.
And I'm pausing. This is the order that we placed right here, that middle line. Now that we're in the trade, we have a target and we have a stop loss order. The target is up here where you want to take off half of your position, 2 of the 4 contracts at a $100 target. So that's why you want to sell 2 of these contracts at that level. Now I said the maximum risk is $100, but it could be less based on the range or size of the bar that we use to gauge everything. That's called a setup bar. Well, this one's already pretty big. There's not a lot of room for improvement, but let's do that. You just drag it to the bottom of the bar and back off 1 tick, and there you are. If that had been a much smaller bar, it would have been a much smaller distance from here to here versus there to there. So you'd be seeing a really encouraging reward to risk ratio. Now, automation has taken over. It placed these 2 orders for you. The only thing you did manually was snug up the order just under the bottom of the bar. Not at it, but under it. And these 2 orders are tied together, more automation, in what is called an OCO. That stands for one cancels other. A lot of people just call it a bracket. Years ago, when I was starting out trading, I hit a target, I thought I'd made some money, I turned off my computer, but I'd forgotten to cancel my protective stop loss order. And guess what? I woke up the next morning and the market had touched that order. Well, it wasn't a stop loss order anymore. It was actually because the trade was finished. It was just a resting order to do something. And it started a brand new trade. And overnight, the market went against me. And I woke up the next morning over $4,000 underwater. Well, I learned my lesson. I want a bracket or OCO. This is automatically done for you. If we hit the stop loss order, for example, and we don't get to the target, then this is straight canceled. You don't have to worry about doing it. Nifty feature. So let's turn this back on. It's on normal speed. And as I speed it up a little bit, maybe to say 6 times normal speed, I want you to ask yourself, how many times have you been in a trade and you said, oh, it's not going any further, I better get what I can and jump out. And after you jumped out, it went on without you and woulda, coulda, shoulda made a lot more money and you felt really badly. Or maybe you saw it heading down to your stop and you said, oh, I better pull the plug before I lose the whole thing. And you jumped out and again, it would have gone without you. Wouldn't it be nice if you had a hedge? Something that would automatically move your stop to break even where you entered plus 1 tick of profit. And that was done for you. Now you can see the entry prices here for all 4 contracts. It's the same price. And now that the algorithm was satisfied, even though we haven't reached the target, guess what? If we don't reach the target and it turns around, why would you want to let a potential winner turn into a loser? This is your hedge. You've raised your threshold from down here to break even plus 1 tick of profit. That 1 tick of profit for 4 contracts on the Dow is $20. That is more than enough to pay your commission for the trade and still have plenty of lunch money to add to your account. So no, it's not a full-blown winner, but it sure feels better than having a loser. So I know a lot of you like that feature. That takes a lot of the stress out. And again, automation. But we're pretty close to the target. Let's see if we can reach it. So I'm going to turn it back on. Maybe speed it up a little bit.
Target filled.
Target filled. Now I'm going to slow it down to normal speed again. And here are the fill prices. Same price, 2 of the 4 contracts, right there where that little left pointing diamond is on this bar with the arrow pointing to it. That's our $100 target. So we've got a paid for trade now. We have $100 in closed profits in our pocket. They can't take it away. You can totally relax. I mean, you could before when you had your stop at break even and 1 tick of profit, but you know now you've already got a $100 winner. In fact, you've got a $110 winner. Why? Because if it didn't even go another tick higher and came down and scratched, it'll pick up $10 worth of profit from the remaining 2 contracts. And that would be a total winner of $110. But we have all 3 time frames, 9, 3, and 1 trending together. And I pre-selected an exit strategy that enabled me to trail a profit stop. And this is our indicator that does it. Well, it's not yet caught up with where our stop is. So we really don't want to be moving anything. But now automation means you don't have to think about that. So I'm going to go over here, right click, and I'm going to attach it to the indicator. And just a couple of 3 things you need to do. And I'm going to give it a 1 tick offset. All right. Now, to see it in action, I'm going to speed things up so that you can watch it at 20 times normal speed. Watch those blue dots. That's our trade safe automated trailing stop. Now watch when it gets past the red line. Did you see the red line move? It's no longer here. Every time a dot appeared, the line moved with it. Now I'm going to pause for a moment. This trailing stop indicator is very much like a surface-to-air missile. It'll adjust its trajectory, its rate of closure, based on a number of variables, so that if you've got a really good strong follow-through going on, it's going to hang back and give breathing room so you don't get knocked out of the trade prematurely. By the same token, if price is starting to go sideways like it is right now, notice how it's getting much closer to price. It wants to lock in as much profit as possible. Now, if price does start to go back up, it'll hang back. Now that you know how that works, keep an eye on how it adjusts itself. This is at 20 times normal speed. And I'll move this over a little bit so you can see it better. All right, so it's hanging back a little bit. But if price starts to go sideways, see how it will readjust itself and get closer and closer.
Stop filled.
And I'm pausing. It hit the stop right there. And that's the exit price. So if we entered 1 tick above this setup bar's high at that little right pointing diamond, we took $100 off the table here and trailed an automated profit stop to there. What do you think we made? Well, let's open up Chart Trader and look at our profit, $730. Well, I would say that's a pretty decent return on your risk. Are all these trades going to net you big profits? No. That's why we don't have a one-size-fits-all. We end up having an adaptive system with different exit strategies all based on the strength of the trend, which I showed you at the beginning. How do you determine the strength of the trend? Then I showed you this actual trade where we had strong trend and we elected, before we had a setup, an exit strategy to maximize it. If I would have had a weaker trend, just the 1 and the 3 agree, I would have scalped and I would have made a quick $100 and I wouldn't have overstayed my welcome. So I hope you like what you're seeing here and that this makes really good sense. I'm going to hide that. And what I'm going to do next is I'm going to pause for a little bit. And I'm now resuming. And we're back where we were in my presentation before I took you to the charts. So I showed you a sample trade so that you could see how the system actually works on charts. What I would like you to know is that trend following, which has been around, gosh, it's as old as dirt, nearly forever, it's the safest and by almost universal acclaim, the most consistently profitable way of trading. I know breakouts and counter trend have their advocates, but believe me, they are really hard to teach and learn and trade consistently. So let's review a few things and then we'll wrap it up. We use these things called multiple time frames, or charts with different settings. They're tuned to very specific cycles. I showed you a formula and gave it to you so that you would know, based on what market you're trading, how to end up setting those 3 main charts to get the wide angle, intermediate, and close-up point of view. So this is your wide angle, there's your intermediate, and there's your low-risk surgical entry. Once you know how much trend agreement you have, then you pre-select the appropriate exit strategy so you can adapt to the market conditions. You change like a chameleon. You're always adapting. And of course, we really want to keep that risk under control. If you're scaling out, it'll never be more than $100 per contract traded. Pardon me. If you are trading the minis, for example. And of course, 70 or less if you're scalping. And you saw the automation. It really comes in handy because sometimes the markets just are a little bit too quick for some people. Wouldn't you rather have the automation built in to make those decisions for you based on reliable history? All of this put together adds up to a true rules-based mechanical Boolean logic system. Your entry steps, there's 4 of them. Let's review them real quick. You must have trend agreement. The minimum is the 1 and the 3 need to agree. Best is if all 3 agree. Then when you have that, you don't need to look at the 9 and the 3. You can either look at the 1 minute or the tick charts for a pullback or retracement to a specific moving average, and it has tolerances, certain number of bars, distance from that moving average, etc. And you have an indicator that gives you a tick by tick, moment by moment feedback as to how close you are. Are you there? Are you there? Yes, now you're in the sweet spot. And then you make sure that your oscillator has reached overbought or oversold. It too, by the way, has its own tolerances, a specific number of bars before overbought or oversold for your setup bar. And then the last thing, of course, is when all that's been satisfied, make really sure that your risk is at the maximum or less for the exit strategy you had pre-selected. And you saw the indicator that showed you tick by tick, moment by moment, exactly how the risk changes as the bar grows in size. So you have this kind of precision that you will not find anywhere else. I know there are people teaching ways of entering on pullbacks, but you will not find the degree of precision that you have here. And this system has been proven over 20 years of trading. It is not curve fitted or over optimized. It worked, as I said, right on through the big recession. So you can depend on getting consistent results. So if you say, yeah, I would like to trade the trade safe way, give me a roadmap. Well, here's what you would do. Once you are in the Trade Safe program, I want you to know that you're not just going to get a piece of software with a little bit of support, maybe a video or two. What I have done is put together an entire course that, yes, you have up to 90 days to complete it, but almost nobody needs that long. It is self-paced, so no, you don't have to take 90 days. If you're a quick study, you can do it in a lot less. You'll get started in a password-protected members area where you will be walked through one lesson after another. And as you go from lesson to lesson, you must take a little quiz to satisfy that you really know your stuff. And the first few lessons are basically formulated to make sure that you've got your system installed right and that your charts are all set up and your account is opened and so forth and so on, and that you spent some time pushing buttons and making mistakes on paper before you join me in my classroom. And that's when you move from being a freshman to a sophomore. And all I ask is that you devote one morning a week. That's all. One morning a week. Be with me. Let me be your personal mentor and coach in a very small coaching room. I don't call it a trading room because this is a place where you can ask questions, not by typing, but by using a microphone. A headset is recommended. And even in the middle of a trade that I'm taking, you can say, why did you do that? And I'm thrilled because that means you're asking a question. I also do something that nobody else in the whole industry does. If you need me to watch you take a trade and make sure that your charts are set up right or you're doing things correctly, I can coach you through any problems. I can see your charts with your permission, of course. So our classroom is not like those huge trading rooms with hundreds of people where the guru guy or gal is, said, I woulda, coulda, shoulda taken that trade. Maybe they will, maybe they won't, and they typically hide the losers. I'm going to take every trade that is being signaled, especially the losers. Now, why would I take a losing trade? For the simple reason that you need to understand why that trade worked or didn't work. I'm going to be telling you before the trade happens what to look for, how to get ready as you enter the trade with me. And as the trade unfolds and the automation does what it does, I'll keep commenting on things. And then when the trade is over, I will give you a full post-trade analysis so that you'll understand why the trade worked or did not work. The reason I do that is because I give you a lot of special tools so that you can become a professional trader. I don't want you to be an amateur. I really want you to have a level playing field. I want you to end up being as good as any professional. So one of the tools that helps you is a trading journal. Instead of taking a trade and flitting from that trade to the next and the next, and you don't really learn anything that way, that's what people end up over trading, and then they complain, well, that didn't work. I'm going to go buy the next thing, and then they eventually get burned out and said, I'm not going to buy anything else. They all are ripping me off. Well, in this course, you're going to get the kind of professional attention and tools that get you up to speed as you go from one morning a week as a sophomore. When you complete various little performance tests, you'll then be a more advanced student. You'll move up to the junior level. And we have that on a different morning of the week. That's right. I don't commingle the beginners with the advanced students. I segment them because the advanced students get really bored with a lot of those beginners questions. Yeah, they were beginners too once upon a time, but they don't need to hear that anymore. So they're on their own morning. Now you may say, well, one morning a week, whether I'm a beginner or an advanced student, that's not much trading. Well, that's right. Because just like in graduate school, where you have an intensive classroom session for a few hours, the rest of that week is homework for you. So I devote a morning of intensive coaching from before the market opens until lunchtime. You can stay in my coaching room the rest of that day if you want to. I have a co-moderator who can also answer questions and coach you if you need it. But he's not going to show you his charts like I do. He's going to just be there as a resource if you need him. In the meantime, you can team trade with your fellow students and talk to each other with your microphone. Do you see this? Do you think that's a setup? And so on and so forth. But if you say, no, I'm tired, I'm done, you can leave and you can have the rest of your day to yourself. But you are really required to do homework. And that means for the rest of the week, and that depends on what your schedule is, for the rest of the week, you will want to put in practice trading time. When the market is open, that's real-time trading, and to the degree that you have available time for that. But even if you had unlimited time, you're still not going to be able to take every single trade because it's just not physically possible. For example, the three indexes that we use as teaching vehicles in our course, the Dow, NASDAQ, and Russell, they sometimes have signals almost at the same time. Or maybe you're in a trade in one of those markets and another one is setting up. You're not going to be able to get all the trades when the market is active. So what do you do about that so that you can maximize your practice time and go up the learning curve more thoroughly? Replay, just like I did on my charts. I did a replay. You can fast forward through an entire day's worth of trading in an hour or two. And then when you see trend agreement, the one and the three at least agree, you want to slow it down and wait for the pullback. Don't stay on fast forward into the beginning of a setup for a trade because you're going to miss important context. And that's something that I teach my students as a bonus. Context is what's going to push your numbers way above what the system can do all by itself. Context means anything that's not part of the system. For example, support and resistance. We all know that if you were to buy and your target is, up there somewhere, but between where you entered and your target up there, there's a really heavy duty resistance level. Well, you and I both know that the odds would be a lot better for that trade if that resistance wasn't there. I teach with real metrically based variables how to determine a graded form of support and resistance. And that's a fancy way of saying a daily chart support or resistance has a lot more stopping power than, say, a 9-minute chart support or resistance. We all know that, but I'm going to give you a metrically based way of determining it. There's lots of other kinds of context, things like reports. You don't want to try to be in a trade going into a report. That's suicide. Other things might be the volume just drops down really low. We don't use volume, by the way, in our system, but you at least need a minimum amount of volume for getting decent fills. So I teach all of these things, many types of context, so that by the time you reach senior status, you're ready for the final phase of the course. And that's where you be benchmarked. Up until then, you were in my classroom and you had pardon me, homework on your own for the rest of the week. And you could do replays, remember, uh, after supper or on the weekends or whatever was convenient for you. But in benchmarking, I'm not going to be there pointing anything out. Pardon me. In benchmarking, you are going to call upon everything that you've learned, including the context from all that journaling that you had done and the spreadsheet that I gave you to track your stats so you can run your trading really like a business. You will then be allowed, instead of having to take every single trade, including ones that I might say in the classroom, oh, that one's going to be a loser. Well, I'll take the trade because it's a teaching opportunity. But when you're benchmarking all by yourself, I'm not there to point anything out. You get to pick and choose out of all the signals that all the students will see the same signals, but you might not pick the trades that you're comfortable with. Yeah, that's because of the human factor. Your subconscious, and I'm putting on my therapist hat here for a moment, your personal trading psychology is going to dictate whether or not you're going to be an aggressive trader or a really conservative trader. Wherever it falls, you're going to select the trades that are in your comfort zone. At the end of a statistically viable sample of at least 30 trades, more is better, you meet with me offline. And using that spreadsheet that you got from me as part of the course to track your stats, we're going to review your trading history. And we're going to look at which of the tools in the Trade Safe toolbox gave you the very best results. Because you might have used the 1 minute chart on some trades and different tick charts on other trades, and you might have scalped on some trades, or you might have scaled out on other trades. What we'll do is we'll drill down, and numbers don't lie. We'll find out the exact combination of which chart and which exit strategy gave you the very best results. And what kind of results would that be? Well, in 2018, of all the students who chose to complete the course and go all the way through the benchmarking, 100% of them, every single one of them, achieved a minimum of 87% winners versus losers. That's the lowest that they got. So I'm not promising that you're going to do that. Again, I'm not allowed to promise, but I'm only telling you how well my students did. So wouldn't you like to have a winning percentage of, hey, at least 70 or 80%? That's probably better than what you're doing now. But 87% sure is attractive, and you will have the proof that you need to confidently go ahead and start trading your live account. And it will be much more realistic than just if you push buttons and sim traded and finally traded live, and then all of a sudden you got whiplash from all your emotions because money was involved. We're doing it in a structured way with routines. Everything in the course is structured, from the software to the coaching, everything is structured. So if we wrap things up, let's take a look at the value of what you're going to get with the Trade Safe system. If you look at what's out there today that is really a true mechanical system, and trust me, a lot of people will lie through their teeth and say, my system does this and that. And it's not even a system. They just call their indicator or two with a few loose rules that are very subjective. They'll call it a system, and it's not. It's easy to slip into that. Don't do that. There are maybe a handful of true mechanical day trading systems that are on the market today. And if you start at the low end, 3,000, you can go well past $10,000. No, don't worry. I'm not going to ask you to invest that kind of money. So even if we priced the trade safe system all by itself with nothing else at 3,000, let's start adding on some value. You're going to get me as your insurance policy, your personal mentor and coach in your corner in the classroom. I'm also available offline. You can talk to me for up to an hour if you need to, and I'm available that way also. Now, when I consult with corporate clients, I bill at 500 bucks an hour, and I get it. So you're getting me for the full duration of 90 days for the course, okay? We start you out, instead of making you attend a weekend webinar like I used to do. People would say, I don't want to sacrifice my weekend. Can't you at least record it? Well, I took live students and I recorded an entire weekend webinar and broke it into bite-sized chunks so you can watch the training videos at your convenience. Now that's just to get you started. Then you will want to use our installation platform that helps you plug in the TradeSafe system into NinjaTrader. So it's about a 5-minute process. It's very, very easy. However, if you're one of those people who barely knows how to turn on a computer, I really hope you learn Windows. You shouldn't be day trading if you don't know how to operate a computer, right? But if you're one of those people who gets stuck, and yeah, it does happen, we're there to help you. I have a full-time support desk, Zendesk, and I have staff that can remote access into your computer and assist you with your installation process. So don't worry, we're not going to leave you hanging there. You saw that trend indicator where it both showed you visually the colors and the boxes for trends and congestion, as well as the audible alerts letting you know whether you're in congestion or in a trend. You also heard it while you were in a trade, let you know about as the trade was unfolding, what was happening. That's all there. You saw the precision of the 4 steps getting into your trade, from trend detection to pullback to oscillator confirmation and risk determination. All of that is included. You saw one of our 3 exit strategies and the automation. You didn't have to lift a finger. Once you were in the trade, yeah, you could have not dragged and dropped the stop that extra little bit if you didn't want to, but I recommend doing it. Why risk more than you have to? But the point is, once you're in the trade, that's it. It's automated. Now, when you're benchmarking yourself at the end of the course, I know that 87% winners versus losers, that's real high expectancy, and a lot of people still wonder if that could be true. But you know what? During their benchmarking phase, my students typically generate between $3,000 and $5,000 worth of profit, which gives them a strong heads up about what they can reasonably expect. When you're in my classroom, if you have to leave early or maybe you missed one of my classes, I record everything I do and say, you'll see my charts, you'll see your charts if you're in the class and you ask me to help you, or you'll see somebody else's if I'm helping them. You'll hear them talking, you talking. It's all recorded, and I've got literally, well, scores and scores, if not hundreds of hours of archived classroom sessions for you to review at your convenience. Now, I've also created some very special how to do it tips, tricks, and techniques videos that are also as a bonus. And I want you to run your trading like a true business. That's what professionals do. If you're going to run with the big dogs, you got to be a big dog. You got to have a business plan, not just to map out your pie in the sky financial goals, but you better do what a real business does. You better anticipate the bad stuff. And almost no amateurs ever have anything in writing that they have to sign off on, and I review it personally. And that would be things like, what do you do if you had, say, 3 losers in a row? Do you keep trading and dig a deeper hole? Or do you quit? Or what do you do? What if you have a certain amount of money that you've lost in a day or in a week, or your percentage drawdown overall to your account? Pardon me. You really need to put limitations, boundaries on your trading. And that's what the business plan is for. And I'll personally review it. And if I feel you need feedback, I will ask you to revise your business plan. Once you have it, once a month you should look at it and update it accordingly, or more frequently if things in your financial situation do change. I already told you about the trading journal. That's what you do after each and every trade. It's pre-formatted. All you do is fill in the blanks and make sure that you are accurately summarizing exactly why the trade worked or did not work. How else are you going to learn? And of course, the spreadsheet, you need your stats. All businesses need their stats. So you get a very granular macroed spreadsheet that will help you make a determination about, oh, what change do I need to make here? I can see what I used to do. Okay, this is what I should do. Last of all, calling on my background as a psychotherapist, I have an extremely powerful technique that is available to help you forge Diamond Horde discipline. It'll keep you from overtrading or getting stuck in analysis paralysis. It was originally created, back in the first Gulf War to help soldiers who had PTSD. When medication wasn't working, this would help them reduce their stress level and stop that automatic reaction thing where if there was a loud noise or something else and they immediately went into uh, you know a posture to defend themselves. Well, it works for more than soldiers. Athletes caught on quickly. Professional athletes use it almost universally. If you're a golfer, it gets rid of the yips very quickly. A lot of people have spent thousands of dollars getting rid of the yips, but I use it for trading, and so should you. And it's included as part of this course. Now, you can see by this time we've got over $11,000 worth of values. I've already told you, no, don't worry. We're not going to ask you to spend that kind of money. So let's take a look at what you're really going to get for your money. With 11,000 or more worth of value, normally we ask $39.95 for the entire Trade Safe package. Everything you saw there, and nobody else includes all the things that we do. For a limited time, this is a special offer. You will not have to pay $39.95, and it's only for those who are watching this today. You can go straight to that link. I wish I could have you click on it, but you can always pause and write that down, and then you could put it in your browser and it will take you to the online form. Well, you're saying, well, that's great, but you still haven't told me what am I going to pay? Well, I did say it's a limited time offer. The doors are going to close 1 week after you've watched this. So we do have a payment plan for those who say, yeah, I know he keeps holding off. He hasn't told us the price, but I don't know. Even if it's a lot less, I don't think I have that kind of money. What if I told you I had a payment plan? So that sweetens it. We're going to give you all of this not for $39.95. We're going to slash a full $1,000 off, and you get it for $29.95. Okay? So this limited time special offer is good for 1 week. Then it goes back up to $39.95. What about that payment plan? Well, if you click on the link that you'll get in a follow-up email, or you use the link, or you wrote it down or put it in your browser, When you get in your browser and go to the online trade safe form, you're going to see a couple of buttons. There's going to be one button for using your credit card if you're ready to pay in full, but there is a second button that you could choose. It's gold, and it's for PayPal. Now, some of you say, oh, I don't want PayPal, I had this or that experience, or don't you have to put money in PayPal or something? No, you don't. It takes only a couple of minutes to set up a PayPal account. In fact, once you click on the gold button, if you don't have an account, it'll prompt you for some basic info to open a PayPal account. Like I say, it just takes a short period of time. Once you've done that, or you've used your credentials to log in if you have an account, after you've logged in, it'll take you to a page summarizing what you're going to get. Well, scroll further below that. Go all the way down to a section where it's called Bill Me Later. That's the payment plan. They will give you 6 months to pay them back. They end up paying me up front, but they will give you 6 months to pay them the full amount. Now, they don't put you on some kind of notice. It's up to you when you want to pay them. So don't, expect them to notify you. Because if you get to 6 months and you never paid them anything, or you didn't pay them all the way, then they will charge you the interest, and yeah, you'll have to pay them off eventually. But if you do it within 6 months, which is really easy, because think about it. If the course is 90 days or less, and you're already starting to maybe make 3 to 5 grand over a 30 trade or more period like you did in benchmarking, then you'll be able to come up with enough to pay it off. That's your goal. So you'll be able to pay it off before your 6 months are up. You don't pay a penny of interest. It's exactly like having free money. The only downside of this is PayPal doesn't make this available to anybody except US citizens. So I'm really sorry about that. We don't have any other alternative for a payment plan than this one. So if you're ready, use this link, daytradesafe.com/I want in. And it's only $29.95, not $39.95. It's $29.95 for everything. Now, if you've got questions, I really strongly encourage you to get them answered. I've already promised you at the very beginning of this that I will not treat it like a sales call. I want you to get your questions answered. I want you to feel at the end of our time, I'll give you a full hour of my time. I want you to feel that your time was well spent, so that you know if TradeSafe is really right for you. I find that that works the best instead of trying to twist somebody's arm, because there's so much of that hustle that's in this industry. I don't want to be one of those guys, okay? So I do want you to call me, schedule it. You'll get a follow-up email after you've attended this. It might be later in the evening or the next day, but you should get a follow-up sequence of emails with a link to schedule time with me. You'll see my calendar and the available dates and openings that I have. When you do schedule, though, please keep your commitment. Don't be a flake, because I send you reminder emails as well as texts to your mobile phone so that you will be able to keep your appointment. Because I'm setting aside a whole hour of my day when I could have been trading, and I'm doing it just for you. So I hope you like what you've seen here today, that you feel that this is not only worth it, it's irresistible, that this is a true mechanical system that you can use. It is not rocket science, but it is extremely precise. So please take advantage of it. I want to thank you for joining me in this presentation. I appreciate the time that you devoted. At this point, I'm going to go ahead and stop it, And I look forward to visiting with you, schedule time with me, and of course, I ultimately look forward to having you join TradeSafe. So trade safely. Bye bye.